Hi, this is Isaac Island. I'm going to try and help you out on accounting 423. So this is a brief, half worked out so I can explain the concepts and not have to worry about the numbers as much. So what you'll find is that what we're doing is we're trying to close out the accounts. We want to make sure that when we start a new year or if they're doing it monthly, we start with zero for everything that needs to be zero. So the balance sheet is one of the few places where it doesn't start out at zero. We want to make sure we start out at zero so that we can go from there, so that we have a fresh slate for the next time frame. So that's what all this work is about. But what you'd notice is that, service revenue, rent revenue, after you've balanced the account, that's actually going to be on the credit side. So what we're doing is we're debiting service revenue and debiting rent, and we're crediting the income statement to counter those. So we add those two numbers, 35,360 of the service revenue, and the 14,110 of the rent revenue. We add those together to add the income statement as we are balancing the revenues. And what we've got is 49,470. And we're countering it so that the revenues are zeroed out so that the next semester or next time frame is balanced out to zero. And we're going to do it for the income summaries, not statement, summary. Let's correct that for you so that you know what I'm saying. I might be spelling it. And it's the same thing. So we're adding up all these expenses, which are normally on the debit side. We're zeroing out, so we've got to credit them so that the salaries and wages expense can be zeroed, as well as the rent expense, et cetera, et cetera. We're putting it on the income summary, which is going to be 42,453. 42,453, excuse me. And that should balance out fairly evenly now, so that the expenses are zeroed out, so that the new year starts with zero. The income summary is actually going to be, once again, this minus credit, debit, we end up with a credit of about 7,017. And so what we do here is we have 17,000 to 7,017. And now income summary is zeroed out, and retained earnings is going to be, this is crediting retained earnings is not what retained earnings is going to end up being, but for now, keep doing that. That's what we've got. It balances out so that income summary is now zeroed out itself. It's a temporary income summary is a temporary table that allows us to help close out the files so that the stockholders' equity, when we get to it, is going to be accurate, and that the net income and net expense is zeroed out. So we've got dividends, we've got retained earnings of an equal portion, and now this number here should equal the net income, and the net income is then minus dividends down here is what's going to give us the retained earnings for this time frame, and that's important. The income summary is a temporary thing that allows us to zero out the revenues and zero out the expenses so that we can get the net income and dividends to be accurate in retained earnings. Now, one thing to notice is that the balance sheet doesn't zero out. After we get the retained earnings, it adds to the balance sheet. The balance sheet is one of those few tables that's not going to need to zero out. I hope this explanation didn't just show you the numbers. I don't think going through the math is that important. I think the concept is important. Revenues are going to be on the credit after they've been balanced. You want to debit them so they get zeroed. Same with expenses. We want to make sure, and then we zero out the income summary so that the retained earnings is reasonable. Thank you very much. I hope you all had a... If you've got questions, please feel free to ask me at any time. Thank you very much.